In my personal opinion, in order to see risk assets flourish, i.e., cryptocurrencies, aside from random institutional demand coming into this market and it completely detaching itself from the macro environment, which, in my personal opinion, once regulations come into play and institutions start onboarding themselves into this space, I have a firm belief is going to happen. Alrighty, what is going on, everybody? Welcome back to another CYPRX video breakdown. This is going to be a very informative video breakdown. This is not going to be your, hype video breakdown. This is going to teach you all some very informational things to be paying attention to, okay? And here at CYPRX, we've been one of the only communities trying and attempting to in-depthly teach people how to pay attention to this through little tiny gems that we've been posting on X, on YouTube, on our new Instagram, and hopefully you all have been paying attention. So we're going to go over the macro environment and what's been happening via these global central banks, why risk assets, in my personal opinion, are down, understanding risk flow, risk on, risk off market mood, where capital is at in the moment in the market. If you guys enjoy these video breakdowns and you actually learn something valuable, remember, this is not a hype video. Here at CYPRX, we're not hype men. We're really trying to educate people and bring value in the form of knowledge and education so that way you can implement this throughout your entire trading and investing career. The things that we talk about here at CYPRX, the things that we go over, you guys can actually use and implement. It's not, things that are not valuable. Really pay attention to what it is that I'm about to go over because we tried to show people what was happening behind the scenes. And I'm going to prove all of that to you all today in this video breakdown. So we're going to go back to December 20th, 2023, last year. I said to you guys, important read. This is on the X space. Successful trading and investing requires more than just time in the market. It demands a commitment to continuous learning and a deep dive into the essentials. The essentials are, and this is layered, okay? This is layered from my personal perspective, which you need to understand from first to last. Obviously, of course, aside from, psychology, market fundamentals, lay the groundwork by understanding core principles of the market, its intricacies, and the factors that drive it. Knowledge is your strongest asset. By the way, towards the end of this video breakdown, I'm going to go over digital asset, Bitcoin price action and correlation with the DXY and what we've been talking about, the DXY strength and da-da-da-da. So make sure that you stick around to the end of this video breakdown. I forgot to cover that in the intro, okay? Second, central banks and macroeconomics. Elevate your perspective by studying the pivotal role of central banks in macro trends. Gain insights into the broader forces shaping financial landscapes. Do you really think that these financial institutions, these hedge funds, these asset managers, these private family offices, they're not paying attention to this stuff? They are. And the fact is that the majority of manual retail investors are distracted by mainstream media-driven agendas, and they're not paying attention to this information, which is why 95% of manual retail investors get caught off guard. And that's why all these hedge funds, all these financial institutions, all these asset managers are always ahead of the game because they are paying attention to these macroeconomics, these central banks, and the movement in the flow of money. Okay, and I'm going to show you how in today's video breakdown here at CYPRX, if you stick around, we literally told you all step by step what to be paying attention to. Okay, I promise this video is going to blow your mind if you stick around to the end. Technical mastery. Charts aren't just lines and patterns. They are your roadmap. Master technical analysis to decipher trends, spot opportunities, and make strategic decisions. Persistence and patience. Success does not happen overnight. Commit to a journey of continuous improvement. Learn from both successes and setbacks, adapting your approach as you grow. Critical thinking. Cultivate a sharp analytical mind, challenge assumptions, question trends, and embrace a proactive approach to decision making. Last but not least, adaptability. Markets evolve. Stay nimble and open to new strategies, technologies, and industry trends. Flexibility is key in navigating the ever-changing landscape. So I put that out to you guys on December 20th. Now let me blow your mind on everything that we've been talking about here at CYPRX. You might as well call us Bloomberg. You might as well call us Reuters. I'm not trying to toot my own horn. I'm trying to give you all freaking value. So pay attention, please. Back on December 27, 2023, following that thread, I mentioned to you guys things that you should be paying attention to as a crypto investor. Again, nobody wants to listen to us here at CYPRX because we provide value. We don't provide hopium and hype. Why has the market been so bullish? Why has the market presented a risk-on market mood? Yes, blah, 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 the Bitcoin halving in the ETF. But market was pricing in an 88% chance of rate cuts early March next year. So pay attention to any shift in this sentiment. Global central bank stance on monetary policy. Fed comments dovish or hawkish. Most recently, they had been dovish, driving increased demand for risk tolerance, hence the increase in crypto prices. Any hawkish comments would weigh on risk sentiment. US inflation data. Any uptick in inflation would not be good for risk assets and would weigh on rate cut narratives and bring back interaction from the Fed, i.e., rates higher for longer or possible hikes coming back to the table. Labor market data. Any positive turnaround in labor market data would signal strength remains in the US economy and bring back a dollar rebound. These are just a few things to be paying attention to. As risk asset investors, we need to see. So these are the things I labeled to you guys that we need to see as risk asset investors to see a full-fledged bull market cycle. Dollar continued to weaken and stay below the 102.800 and 98.300 psychological level historically speaking back in 2017, 2020, and 2021. Failure to break above those significant psychological levels on dollar caused the bull market cycles in previous markets. Inflation continuing to cool. Labor market continuing to see cracks from higher interest rates. If any of the above changes, get ready for a pullback in digital assets. I freaking told you all. If they stay and dollar breaks 98.300, then risk assets are off to the races. We did not get that. So I told you guys what we needed to see best case bullish scenario as we progress. Okay, again, I'm not tooting my own horn. I'm trying to show you all information. December 19th, 2023, I said to you guys, for crypto traders, as always, keep a watchful eye on dollar strength and any changes in sentiment surrounding the rate cut narrative. This would be diminished by dollar strength and healthy economic data from the US. Any decline we see in crypto moving forward will be seen, in my personal opinion, as a dollar cost average opportunity. So I told you guys that yes, we could see a pullback in digital assets, but here at CYPRX, we know the long-term perspective in the digital asset space is bullish. So any pullback, we will be seeing or viewing that as an buying opportunity. All right. So we weren't deploying capital at the end of December. We were waiting. Why were we waiting? Because we knew that the market was extremely greed driven due to what? The narrative that the Federal Reserve was going to cut interest rates. But we knew that January was going to have a massive influctuation of data releases from the US that were going to drive sentiment or possibly change that sentiment. Okay. And I told you all to be paying attention to that. So here's another video from January 2nd as we started the new year. I put out this video where I mentioned to you all what to be paying attention to in the form of risk off, risk on market mood. I'll go ahead and play that for you all.
What's going on, everybody? Real fast. In yesterday's YouTube video breakdown, we had been telling you all to be paying attention to the strength of the dollar and the potential of the Fed rate cut narrative fading out of the market. We had mentioned that risk assets had experienced extreme greed as we ended 2023, with the expectation that the Federal Reserve was going to cut interest rates in Q1 or Q2 2024. However, today we saw an increase in uptick in the strength of the United States dollar and the rate cut narrative start to fade due to optimistic labor market data set to come out from the
Right. So there's just a little brief overview giving you guys video breakdowns. This is now January 2nd. So you guys have seen the progression of everything from December till January of telling you all what to be paying attention to, right? Last but not least, this was most recent. This was just yesterday, yesterday evening, doing my market analysis for the private CYPRX community. I mentioned to you guys, pay attention to dollar strength coming back to the table, along with the rate cut narrative fading. If you pay attention to any of our previous posts, remember that that was the primary factor that drove demand for risk assets. The vast majority of the manual retail herd thought that it was the Bitcoin ETF getting approved. I swear to God, tell me that I'm wrong. Most influencers and most individuals on the X space thought that the vast majority of demand for the digital asset space was driven by the narrative that the Bitcoin spot ETF was going to get approved on January 10th. I promise you, asset managers, hedge funds, and financial institutions were not sitting at their trading desks buying up Bitcoin and the rest of the digital asset space under the assumption that the spot Bitcoin ETF was going to get approved. Go look at when the market bottomed out. The market bottomed out as soon as the narrative that the Federal Reserve was going to cut interest rates in 2024 started to fully manifest in the market. And the market makers started to price that in way before the Bitcoin ETF narrative came into the market. I freaking promise you, go look at the charts. Remember that these central bankers are looking at macroeconomics. They're looking at central bank trends. They're looking at where inflow in the form of capital is going to flow in or out of. So here we can see a fundamental piece from Reuters that talks about how dollar regains after a sell-off in Bitcoin breaching 42,000. So it does talk about the correlation between dollar and Bitcoin strength. Here's another article from Reuters talking about how dollar gains before inflation data as Bitcoin slips. Now, fast forward to the last pretty much 48 hours. What have we seen? Everything that we've been telling you all to pay attention to. US stocks dip, treasury yield gain as solid data dims rate cut hopes. Wall Street extended sell-off on Tuesday, and the benchmark U.S. Treasury yield rose to its highest level in more than a month as robust economic data reduced the impetus for the Federal Reserve to begin cutting its policy rate as early as March. This is literally hysterical because we tried to tell you guys to be paying attention to this and to pay attention to potential pullback opportunities in the digital asset space. As we progress into this fundamental piece, it says dollar hits a fresh 1-month high after retail sales data, excuse me. The dollar index hit a fresh 1-month high on Wednesday after U.S. retail sales data indicated that the economy remained on solid footing, denting the market outlook for any potential rate cuts from the Federal Reserve. Retail sales rose from 0.6% last month after an unrevised 0.3% gain in November. The Commerce Department's Consensus Bureau said economists polled by Reuters had forecast retail sales gaining 0.4%. While markets still see the Fed's first downward move and rate hikes likely to come in March, expectations for a rate cut of at least 25 basis points are down to 57%. So remember, the first analysis that I gave you guys all the way back here, okay, what were the markets pricing in? An 88% chance of that rate cut in early March next year, right? And now that whole entire sentiment has changed down to 57%. So of course, that's going to create less of a demand for risk assets as of time of recording this video. Remember, I mentioned to you guys at the very beginning of this call what you need to be paying attention to. Adaptability. Markets evolve. Stay nimble and open to new strategies, technologies, and industry trends. Flexibility is key in navigating the ever-changing landscape. So obviously, of course, if this sentiment changes, be reactive. That's why I told you guys dollar cost average opportunities if the market does discount, right? Be reactive to this type of information. This is what these central bankers are paying attention to. Here we can see, if we look at this morning's retail sales report, that points to growth on virtually every possible level and across every aggregate within the consumer spending sphere. That points to underlying inflation pressure remaining sticky for longer, and that coincides with the fact that we're seeing a concerted push from policymakers to anchor market expectations out into the middle of the year for the first cut, and also to warn markets that the cadence of rate cuts is going to be slower than anticipated. The dollar index, which tracks the greenback against a basket of currencies of other major trading pairs, was up 0.21% at the 103.51 psychological level. The greenback jumped 0.67%, its biggest one-day percentage climb since January 3rd, driven by higher in part by comments from the Federal Gov Christopher Waller, who said that while the U.S. was within striking distance of the Fed's 2% goal, the central bank should not rush towards cutting rates and its benchmark interest rate until it was clear lower inflation would be sustained. So, another thing that I want you all to pay attention to is how these central bankers, okay, they're telling you all what they're paying attention to, okay? They're not just paying attention to some narrative that the spot Bitcoin ETF was going to get approved, okay? They're paying attention here. Look at this confirmation. This is just, I'm trying to show you guys. It says right here, central banks have been the primary focus of investors. Look at this right here. Okay, I'm not making this up. Central banks have been the primary focus of investors. But which investors? Not manual retail investors that are distracted by the media projection herd bullcrap. These investors that they're talking about in this little tiny statement are asset managers, hedge funds, private family offices, right? They're the ones, if you guys know that you can go and you can read their reports. You can go read BlackRock's report. You can go read the Wells Fargo report, Bank of America report. All these massive financial institutions come out with these monthly and quarterly reports that you can go read to gather this information and the overall directional trend of risk asset classes, okay? Most people don't even understand why risk assets like crypto experienced a massive boost in demand last bull market cycle. It was because of a low interest rate environment and a massive amount of stimulus and quantitative easing being pumped into the market, right? So, of course, most recently, what have we seen? Given the narrative that the Fed was going to start cutting interest rates, meaning that we were going to head or start to head, potentially speaking, according to markets pricing this information in, into a lower interest rate environment, of course, we're going to start to see a demand for risk assets, right? People not understanding that because they're driven by greed and they're driven by market media hype got dumped on when the spot Bitcoin ETF came out. You go look at all the price projections, they were calling for $100,000 the next day, and that never happened. The infrastructural layer, geez Louise, that's a good word to start saying 10 times over, is set in place. Custody solutions are coming. Custody solutions in the form of financial institutions can house their digital assets on a third-party custody provider and not in-house. That's one thing that needed to be solidified that we didn't have last bull market cycle. That is in place. So these financial institutions have a safe place to store their assets, but they don't have the regulatory green light fully on a global scale to start to implement capital into this space. And that's one thing that people don't understand. Now, when that does come into fruition, could it happen tomorrow? Sure. Yeah, absolutely. It could. Could it happen in a month from now? Sure. Yeah, absolutely. I'm not here to give you guys time frames. Okay. That's one thing that CYPRX does not do. I'm here to show you guys information and trends in the market that you should be paying attention to that nobody else is. So with that being said, let's go over my personal perspective of the markets. You can see here when the dollar broke above the historical psychological level of the 102.800. Okay, that is the exact same time, significantly enough, that Bitcoin topped out and that the Bitcoin spot ETF got approved and the market dumped, right? Remember in previous video breakdowns, I had been telling you guys to be watching this historical psych level, where if we go back on the weekly and the monthly time frame, we can see looking at just the dollar pair, and I showed you guys this the other day on 3T Warriors live trade or live YouTube, okay, I showed you guys this, that the market in 2017 and in 2020 to 2021 bull market cycle failed to break above this historical level and started to trend downwards, i.e. the dollar started to dump. We did not get that this most recent retest of this historical psychological level. And instead, what has the dollar done? It's created a higher low in comparison to the previous one. In my personal opinion, in order to see risk assets flourish, i.e. cryptocurrencies, aside from random institutional demand coming into this market and it completely detaching itself from the macro environment, which in my personal opinion, once regulations come into play and institutions start onboarding themselves into this space, I have a firm belief is going to happen. Remember, this is not a bearish projection video breakdown. I'm not sitting here telling you guys the cryptocurrency market's going to sell off. And I'm not sitting here telling you guys that I'm not absolutely bullish on crypto, because I am. If you guys have been paying attention to my research and what we do here at CYPRX, we are 110% bullish on digital assets long term. Okay. But you have to remember why I cover this information, because the vast majority of us here at CYPRX are day traders. That means that we take advantage of these price fluctuations on an intraday level. Because if you're sitting in this crypto winter that we've been in for the past year and a half and you're not making money or you haven't made money, you are slacking. And I'm just telling you facts. Why? Because there has been opportunities to the up and down side by just simply paying attention to capital inflow and outflow of risk assets, by paying attention to what central bankers are doing, paying attention to monetary policy, and paying attention to these data releases and dollar strength. It's literally that simple when you think about it. So, long story short, what I would like to see in order to see risk assets flourish like crypto, putting any type of random demand that we might see in the market driven by some type of positive fundamental, okay? This is just macro environment. I would like to see the dollar stay back below the 102.800. I would like to see the Federal Reserve take a continued dovish approach, the rate cut narrative maintain and stay on the table. Obviously, of course, that's starting to fade out. We saw that 88% decline down to 50, I believe it was 7%, right? The market's pricing in the 57% chance that the Fed's going to cut rates in March, right? And I would want to see the dollar start to head and make its way back down to the 98.300 off of pessimistic US data, driving demand back for risk assets, capital outflows of the dollar, okay? And we all go happy-go-lucky, sunshine and rainbows. Now, look at the macro environment. We just saw geopolitical escalations and tensions rise in the Red Sea, which caused a massive amount of safe haven demand for the US dollar over the past 48 to 72 hours. Also, at the same time, we're seeing an increase or uptick in US economic data, where the data most recently has come out a little bit more upbeat than previous readings, at the same exact time that the rate cut narrative is starting to fade. So this is all leading towards, in the short term, as of right now, in time of recording this video, potential dollar strength continuation until all of these things start to fade out that have just recently changed over the past, let's just say, week and a half to 2 weeks. We have to assume that digital assets, because they're risk assets, are going to experience some type of pullback. I'm not sitting here saying it's going to be some type of freaking 80 to 90% crash, black swan event dump. No, I'm just simply saying it was smart and logical at the end of December, based off of all the information that I've shown you up until the point that we're at now, not to be investing in December and wait for a pullback. Now that the market has pulled back slightly, could you be dollar cost averaging in? Absolutely. If you want to make that decision, expose and risk your capital, right? That's up to you. But I'm just here to show you guys how here at CYPRX, we don't buy at tops, right? Even if, let's just use H bar for an example, okay? Imagine how many people were FOMOing in buying H bar at 10 cents. Right? Where if you just waited patiently, understood the macro environment, and understood that the market was most likely going to experience some type of profit-taking event based off of all the factors that I just showed you, you could have now been buying it at 7 cents instead of 10 cents. And a lot of people will be like, oh, why does it matter if I think H bar is going to go to $1.50 to $2 in the future? Most people don't care about that. Why on earth would you want to plug $1,000 into this market at 10 cents to see a depreciation in your freaking portfolio down to $700 when the market pulls back? Who in your right mind taught you how to invest? Even if you're a long-term investor, why would you not want to see an appreciation in your portfolio in the short term? I don't know. Any investor, in my personal opinion, that would want that. If you want that, I don't know, like I said, who taught you to invest. Here at CYPRX, doesn't matter if we're short or long-term investors, anytime we plug capital into this market, we want to see it in the green. We want to see it in the blue. We want to see it gain value. So if you're one of those people and you liked this type of information and you want to learn more, consider joining our private community. We have two options in order to do so. You can come into our community for lifetime access or just join us in the form of a monthly subscription basis. We'd love to have you on the team. Hopefully this information, again, I'm not sitting here trying to brag or boast. I'm not sitting here trying to tell you that the market's going to freaking tank, drop off the face of this earth, whatever the case may be. I'm just here to show you that here at CYPRX, we provide value and information both publicly and private to our community members. With that being said, many blessings to you guys. As always, be cognizant, be aware out there, understand the macro environment. So right now, right, the vast majority of risk assets are pulling back due to increased dollar strength, demand in safe haven assets due to the macro environment. Rate cut narrative shifting hands, fading out. Also an increased demand in safe haven assets because of the geopolitical tensions and escalations in the Red Sea and the Middle East. Okay, so what we would want to see as risk asset investors is obviously, of course, an increase in institutional demand, because those are the only individuals that are actually going to drive liquidity and volume in this market, along with rate cut narratives coming back to the table, lower inflation readings, weak or pessimistic US data that weighs on the dollar and brings the dollar back down below the 102.8 historical psychological level that created the last two bull market cycles, and an increased risk on market mood, i.e. investors, hedge funds, asset managers, private family offices, the people with the money, because the retail market traders don't have the money to move the freaking market. We want to see them have a more increased risk on appetite. Okay. Once that changes hands, obviously, of course, we'll get the green light for the bull market to be back on. As of right now, we're in a temporary decline. Here at CYPRX, we're going to be looking at dollar cost average opportunities for some potential discounts on our favorite altcoins. Many blessings to you guys. As always, smash that thumbs up button, subscribe to the platform. We do appreciate the love and the support, and I'll see you guys in the next video breakdown.